So, Apple has just reached $2 trillion market cap. What exactly does this mean, and how was this achieved? There are a couple of factors that come into play here. Number one is Apple is a very successful company. They are very good at marketing and selling their products at a very high profit margin. And the fact that they have $193 billion in cash reserves just sitting there is testament to this. The second factor that plays into this is stock buybacks. Since 2013, the number of open shares, that means shares available to purchase in the market for Apple, has steadily decreased and currently is at the level of where it was around 2000, around the turn of the millennium, or the dot-com crash. So stock buybacks are a way to reward investors, but not paying out dividends. It's also a way for the company to pump up their share price and reward the CEO, since many of their payment packages are tied to increase in market cap valuation. So the third factor that comes to mind is passive investing. So ETF investing has skyrocketed in the last couple of years, and contrary to an active investment manager who looks at PE ratios and EBIT data to determine if a company is worth investing in, passive funds have one criteria. Are dollars coming in? If yes, buy the underlying assets. Are dollars coming out? If yes, sell the underlying assets. That is the only criteria that come into play in ETFs. They don't worry about stock price. They don't care about R&D. They don't care about sales or projected sales. It is simply, is money coming in? If yes, buy the underlying assets. And this is really pushing up asset prices. And the fourth factor that I'm thinking of just off the top of my head is new investors coming in. So according to Robinhood, the investment app, a lot of their purchases are made with the stimulus checks that the US government have been sending to the populace. This is obviously people who don't need the money to survive, and for them it's gambling money, basically. So they don't do their due diligence, they don't care about the price of the stock, they simply buy it, pushing up the price, almost like an ETF. The question is, if this $2 trillion is really a relevant metric by which to gauge if this stock is cheap or expensive. So the old-fashioned way of looking at this is looking, for example, at the price to earnings ratio of a stock. For Apple, currently, at the current stock price, that is around 35 or 36, meaning that if I go out today and I buy Apple completely, it would take me 35 to 36 years of profits to earn back the money that I spent on Apple today. Of course, this is not the only metric that can be used. This is why active investors or investor managers, they look at a whole range of ratios and indices to determine which companies to invest in. The reason for this is the PE ratio gets a bit out of whack if the underlying economic conditions change. Coincidentally, the PE ratio for Apple at its peak was 38 in 1999, just before the dot-com crash. what I mean by underlying economic conditions is we currently have central banks all over the world printing trillions and trillions of dollars. It's the loosest monetary policy that we have ever seen in the history of the world. So what this does is it inflates all prices eventually, but at the moment, due to the Cantillon effect, it inflates asset prices. But together with this, printing trillions and trillions of dollars or currency units, whatever your currency is, it also dilutes the purchasing power. So $2 trillion today does not buy the same as $2 trillion in 2000, for example. And that makes it very difficult to evaluate properly if a stock is really cheap or expensive. The best way that I have found to determine whether I should jump in or stay away for the moment is to measure stock prices in relation to other things that you can buy, to measure basically the opportunity cost of investing into stocks. And a good ratio that I found for this is the Dow or the S&P 500 ratio to the gold price. Since the value and the purchasing power of gold is really quite stable, taken over the entire human history, I find this is a very good and consistent metric to use to evaluate if something is over or underpriced. Of course, this is very difficult because we don't have all of this data, but there is a Dow to gold ratio, and it's currently at around 14, which is historically quite high, meaning that stocks in general are overpriced. That is why, for me personally, I stay out of a broader stock market. I'm currently just looking at single stocks in commodities, whether it's gold or silver miners or lithium miners, because of the EV revolution that's coming, and lithium is a key component for those batteries. So that's kind of the things that I'm looking at personally. And for me, Apple at $2 trillion, yes, it's way overpriced. And also, if you look at the S&P 500 minus the FANG stocks, which are Facebook, Amazon, and Apple, Netflix, and Google, the rest of the market is really not performing well. It is merely these FANG stocks that are pushing up the market and which is allowing it to reach these all-time highs. So if you really dig into it, the stock market is still quite fragile. And for me, the risk is not worth the reward. The possible downside and the chances of a downside is higher than 50-50, in my opinion. So that is why I'm staying out of the stock market in general for now. I keep my money in gold, silver, Bitcoin, ETH, and then some of the miners, a tiny fraction of the junior miners. So that was it for today. Thanks for watching.